If you're aware of the current state of the US economy, and you're still not buying gold or silver, you either share the same school of thought as Janet Yellen, or you're eating out of trash cans. Sorry to be blunt, but let's be brutally honest. The US economy, and the global economy as a whole, is in deep trouble. World debt levels have risen $30 trillion since 2007, and in addition, only 28% of Americans feel good about the direction this nation is headed. On top of that, median household income has declined the past 5 years in a row, while the cost of living has continued to increase. And according to the unadjusted numbers, the US economy lost 2.87 million jobs in January, a number that hasn't been seen since the peak of the recession in 2009. Unfortunately, millions of Americans have been told we are in a recovery, but all the data points in the opposite direction. I could go on, but it doesn't take an economics major to figure out that the direction our economy is headed is disastrous. Right now, gold prices are still relatively cheap, because certain market forces are pushing down the price. However, so far 2014 has seen a 20% increase in the price of gold, a sign that gold's bull market might be roaring back. There are many reasons why gold investing is a wise decision, but first let me begin with some fun facts about the Federal Reserve. The Fed has been monetizing our debt since 2008 through a process known as quantitative easing. In layman's terms, quantitative easing simply means money printing. Janet Yellen, the newly appointed chairman of the Federal Reserve, recently announced that she plans on tapering the amount of quantitative easing every month, from $85 billion to $75 billion per month. Of course, many other economists, such as Peter Schiff, think that Yellen will not only reverse the taper, but actually increase the amount of quantitative easing every month, when the market reacts poorly to the taper. All in all, however, it won't matter, because the Fed is trapped either way. Basically, Janet Yellen can either press on the quantitative easing gas pedal even more, leading to a toxic dose of QE, or she can raise interest rates. Either one will be disastrous to the US economy. If the Fed keeps up its QE charade, we will see the dollar lose even more purchasing power, and prices of basic commodities, such as food, gas and energy, will rise. The result will be massive inflation, and a dramatic reduction in Americans' standard of living, as they struggle to make ends meet. This, in turn, will drive up the price of gold, as investors finally realize that the US is not headed for a recovery after all. On the other hand, Janet Yellen could do the right thing and raise interest rates, although this is highly unlikely in the short term. I think what Yellen will end up doing instead is printing more money until the dollar loses so much value that she is forced to raise interest rates, to prevent the dollar from being devalued any further. If the Fed had any common sense at all, they would immediately put an end to quantitative easing, raise interest rates to healthy market levels, and allow the US economy to completely restructure itself. Sure, it would be painful, and we would likely slip back into recession, but letting the dollar collapse under the weight of hyperinflation would be a lot more painful. If the latter happens, we can expect to see the price of gold and other precious metals shoot to the moon. For those of you who think that the Fed has everything under control, and that gold's bull market is over, I advise you look at what happened in Weimar Germany during the early 1920s, when the German mark collapsed under the weight of endless money printing. What happened to the price of gold during that time period in Weimar Germany? It ballooned up to levels never before seen in history, and eventually 1 ounce of gold was 87 trillion marks. Why do I, and many other economists, suspect the Fed will not do the right thing? We suspect the Fed will not do the right thing because it is simply not in their best interest to. The reality is that our entire society is based on debt. Individuals are in debt, corporations are in debt, and most significant, the government is in debt. By printing money, and then using some of that money to pay off debt, it makes it much easier for the government to manage the interest on that debt. Unfortunately, for us consumers, this also devalues the currency that is being printed, which in this case is the dollar. This is why we are likely to see inflation pick up as the newly appointed Fed chief continues quantitative easing, or quite possibly, increases the amount of QE every month, leading to an eventual collapse of confidence in the dollar and investors running towards gold. The naysayers might point to gold's one down year in 2013 as proof that it is not a safe investment, but they forget about the other 12 years from 2000 to 2012, where gold rose from $300 per ounce to nearly $1,800 per ounce at its peak, and outperformed US stocks by a landslide. The reality is that in this current market of quantitative easing and 0% interest rates, gold and other precious metals are very safe investments, and they will continue to be used as a storehouse of value to hedge against inflation and protect people's savings. The only possible bearish outcome I can see for gold is if the Fed actually does the right thing and raises interest rates, which I highly doubt will happen anytime soon. I wouldn't be surprised if we see gold hit $20,000 an ounce, although it's quite possible it could go even higher than that. The Fed is not likely to do the right thing anytime soon, because if it did, the Fed would be forced to raise interest rates, and we would default on our sovereign debt. I seriously doubt that is on the agenda. Instead, what I think is on the agenda is more money printing, debt monetization, and inflation, all of which are very bullish for gold.